Last week was a bit of a crazy week for the markets. We saw a lot of news come out, battered the markets around a bit, but in the end, investors took it all in stride. Early in the week, we did see the US and Japan announce a trade deal, which included Japan investing $550 billion into the US, and the US gets to keep 90% of the profits, some sort of profit sharing. Didn't make a whole bunch of sense because $550 billion is 14% of the GDP for Japan. I'm not sure of those details of if it'll actually work out that way, but a trade deal was announced. Then in midweek, we did see American Eagle announce that they had brought on Sydney Sweeney as a sponsor to the product. She's an actress, which in the end, American Eagle stock went up by 18%. Sort of reminds me of the meme days a little bit. A little bit later in the week, we saw Trump visit Powell at the Federal Reserve. And I'm not going to play the video clip, but if you get a chance to watch it, it is very humorous, actually. It's like a skit out of The Office. Trump comes over and talks about how Powell and the Federal Reserve is overrunning their budget, and comes up with a new number of $3.2 billion for the renovation. And Powell looks at the sheet and says, well, you've included a building from 5 years that was completed 5 years ago. And it goes back and forth. It's actually a little bit funny in the end. Later in the day, we did see Newmont come out after the hours on Thursday and announce really solid earnings, which helped to drive up the gold sector a lot, and Newmont obviously as well. The gold stocks have been undervalued relative to gold, at least that's what many investors believe, and maybe this is going to be a catalyst to help them actually do even better. Now, they've done extremely well this year, but they're so undervalued relative to gold that they could still have some room to go. On Friday, we saw Trump come out and announce that, he's basically said, we're not going to be able to probably negotiate a trade deal with Canada, and they were just going to put a blanket tariff rate on Canada. Now, over the weekend, that all changed. It looks like a number of countries, China and Canada and Mexico, are getting an extension, almost like an indefinite extension. I'm not sure of the details yet. They keep changing, to be honest. On Sunday, just after lunch, just shortly before I started filming this, the EU and the US announced a trade deal. Part of the trade deal was that, the details really aren't clear, and they keep changing, the interpretation of them. But it looks like Europe is going to be charging 0% on US products coming in, except for cars, which are going to be 15%. Currently, right now, they're 10.2%. So a little bit of a boost there, but 0% on the other products, and better access to markets. And also as well, and the US is going to be charging a flat rate of 15% on goods coming in to the US from the EU. I want to say that when we've seen the announcements on trade deals recently, we have seen the market respond positively, but it hasn't created a sustained rally. We'll have to see what happens on Monday morning. If we look at the major sectors of the S&P 500, the performance last week, here as a reference, here's the S&P 500 up 1.5%. Healthcare was up here, the leading major sector. Now, you have to understand that healthcare has been underperforming dramatically for so long. So a little bit of a bounce taking place for the healthcare sector. Industrials, once again, top performing sector, one of the top performing sectors. And industrials have been performing well in 2025. My interest here is the technology sector lagging the market. Usually when you see a 1.5% uptick for the S&P 500, usually the technology sector is actually one of the primary beneficiaries in that risk-on mode. It wasn't. We'll be talking about that in just a second. If we look at the markets here, here's the TSX Canadian stock market down up 0.7%, but less than the US stock market. China, once again, did quite well. If we look at the gold miners down here, strong performance that really was on the back of Newmont coming out with very strong earnings. Gold, by the way, was down a little bit last week, so a little bit of a disconnect from this between gold miners and gold. And if we take a look here, home builders once again performed well. Doesn't make a lot of sense, more of a risk-on move for this. This sector continues to come up with bad reports. We did see an economic, the economy has had a couple of stronger reports for the US than expected. We'll have to see if that's sustained, but the beneficiary for that was the home builder sector. And here's uranium. The previous week it was up over 9%. It settled back down here. Still did a strong 2.2% gain for the week. Now, I want to talk about what's driving this market here between retail investors and institutional investors. This has been a retail-driven market, not institutional. You'll find a lot of institutional players who have actually been hedging, exiting positions, short selling a little bit. And if we take a look at zero-dated traded options, these are relatively new options for the market over the last few years. And now they have taken up to 65% of the total for the S&P 500. This is very much a retail product. Institutions do use it, but it does show this increase here that, in fact, we're seeing retail actually driving this market as they do like this sector to play with. This graph shows retail activity from 2018 to 2025. Here we're seeing this uptick here once again with retail as far as what's driving the market. And we're starting to see some goofy stuff in the markets. Here's GoPro up 98% over the last 5 days, and then it crashed 35% from the market. This is very much a retail phenomenon that's taking place. I saw this graph being put out this week. This is U.S. margin debt exceeds $1 trillion. Yes, margin debt has gone up a lot, and so that's largely been some of the retail investors borrowing on that. This is a nominal amount, but you have to be careful. That's not really adjusted for GDP. I actually did this graph here from the Federal Reserve and adjusted it for GDP. You can see that we are still really high, and we're really around the tops we were for 2008 great financial crisis and in 2000 for the tech wreck bubble. Not as high as we were into COVID, but still quite high at this time. This graph shows the margin debt divided by the money supply M2. And there is a relationship between this relationship and this line down here, this blue line, lighter blue line, which is the S&P 500. And you can see here that they tend to peak around the same time. And what we've seen here is we've seen margin debt increasing even relative to money supply, which has been increasing recently as well. And we're at the levels we've seen some of the peaks not so long ago here. We still are not at the peak from the great financial crisis or even back in the tech wreck bubble. So perhaps we do have more to go, but we are at some of the peaks we have seen recently. And the retail play that I was talking about here is showing up in American Eagle. Here we can see they took on Sydney Sweeney as a promoter for their product and up 18%. Just huge amounts based upon that announcement. That's definitely a retail type of flavor that's happening in the market. This graph shows the Goldman Sachs most shorted stocks index. And you can see here that the most shorted stocks have been performing really well. And this is relative to the S&P 500. So this market's really been driven by a risk-on move. And we're seeing short covering forcing the stocks higher. Here's a graph of the S&P 500. Here we are reaching all-time highs. And here's the RSI. Now, I put out a video and talked about this in my last weekly video as well. When the RSI crosses below 70 in either July or August, what you tend to see is the stock market lower over the next in August and September. And what we've seen here for the RSI is we've seen it move higher here, back over 70 again, into overbought territory. So just because it's got crossed below 70 and moved back above doesn't negate the fact that we're likely to see lower values over the next 2 months. In fact, we saw that back last year here, where we saw that crossover take place initially here, we'll go back over again to become overbought and then turn lower, and the stock market made a move lower. This graph shows XLK, the ETF for technology, and this sector has been performing particularly well. Here you can see that the sector has performed particularly well, but if you notice here, this graph here is relative to the S&P 500. We're starting to see this sector roll over here, and that's a little bit of a concern. If the technology sector is having trouble leading, and it has been the leader, it's 33% of the S&P 500, if we start to see that roll over, that means the other sectors have to pick up the slack. But typically the big sector that's leading, like technology, when it starts to roll over, it does impact the overall market as well. So it's just something to watch out for, and could be showing early signs that the market is moving from a risk-on period to a risk-off period. Something to watch out for. There's lots of stuff coming out next week. This is an extremely busy week on the economic front and the earnings front. Probably the bigger releases this week. You can see the Fed release its decision on Wednesday. Then you have PCE, core inflation coming out as well, cost price index coming out. And then on Friday we have the non-farm payroll number coming out, unemployment. So lots and lots of stuff coming out on the economic front. And on the earnings front, we have major companies reporting: Apple, Microsoft, Amazon. Some huge companies reporting. A very busy week for the earnings coming out this week. So busy on the economic front and earnings. So we likely will see the market really start to move around a little bit. This graph shows the U.S. This is the U.S. and the expected probability that the Federal Reserve will be cutting its interest rates. Here is the federal funds rate at 4.5%. You can see here that this Wednesday, they're not expected to cut at all. Very small expectation here of cut. It's not really until September do we start to see the expectation of a cut taking place, at least one cut taking place. So it's going to be more about what Powell says after the meeting, which is going to be very interesting to see if he starts to become more dovish or really digs in and pushes back on Trump, which is a possibility here. And we are starting to see a lot of Federal Reserve members actually starting to become more dovish. So Powell might be a little bit isolated in his fight. This is going to be extremely interesting. Here's Canada here. The overnight rate is currently 2.75%. We don't see, according to this, an interest rate cut until December the 10th. Investors or homeowners are really expecting the Bank of Canada to cut interest rates, but the market is not. Here's something from my social feed. Here's the VIX, and if you take a look here, it's near the lowest level of the year for the VIX. This means there's a lot of complacency in the market, but watch out. If we take a look at my Thackeray's 2024 Investors Guide here, this shows that this is the VIX annualized performance from 1990 to 2022. You can see here that right now the volatility tends to be low in the markets on a seasonal basis, but you tend to see this really pick up here starting in, late July, right where we are now, and into October. This is a time when volatility increases. And if volatility is increasing, that might not be good for the markets. This is a quick reminder that on a seasonal basis from 1990 to 2024, we see the worst two contiguous months, August and September, for the markets. July tends to be strong, but that's the first half of July. That's where most of the gains are made for July. So this is the second half. And so far, we've seen the market still hold in here in late July, coming to the last week of July. The stock markets have been performing well coming to the last week of July. And I've talked about the tendency for the stock markets to perform poorly in August and September, which are the two weakest months of the year on a contiguous basis over the long term for the S&P 500. But what we also have noticed on a seasonal basis that tends to happen is the narrative can change, have a reversal that takes place around year ends, quarter ends, and month ends. We saw that in 2024 coming to 2025 and around that year end. So if we go back to 2024, the U.S. stock market was outperforming. The U.S. dollar was outperforming relative to world currencies. That all changed. Investors flipped the narrative in the new year. And we saw the U.S. stock market underperform Europe. We saw the U.S. dollar actually underperform as well relative to world currencies. That narrative can also flip around quarter ends and month ends. And right now, coming into the two weakest months of the year with a market that is quite stretched at this point, we could see the narrative flip, where investors have been pushing this market higher on the retail side. And yes, that can continue to move higher. But retail investors have really been trying to capture these gains. And perhaps in August, as we hit a weak spot, they could actually start to look at the market a little bit differently, particularly if there's a catalyst that takes place. And we might start to see the market actually have a different tone. Doesn't mean it's going to happen, but this is often when we see the narrative change and the directional change in the market take place. So it's going to be an interesting week coming up as we have the last week, almost full week for July as we move into August right now. And it's going to be another interesting one to watch. Thank you very much for joining me today.